Good afternoon, and welcome to Farm Focus for Friday, January 17th. Grain markets closed higher to sharply higher today, reversing yesterday's lower closes, mostly of today's strength due to rumors of China buying U.S. corn. March corn futures finished 14 cents higher today at $3.89 per bushel. New crop December corn up 9 cents at $4.03. March soybeans 6 cents higher, finishing at $9.30. New crop November beans up 4 cents at $9.61. Kansas City March wheat was 10 cents higher on the day, finishing at $4.94. Minneapolis March wheat up 8 cents at $5.58. Outside markets were relatively quiet, but overall providing maybe a light positive influence. Crude oil is currently 8 cents per barrel lower at $58.44. Ethanol up 6 cents per gallon at $1.36. Gold up $11 an ounce at $1,561. The U.S. dollar index up 31 points at 97.37. And the stock market currently 30 points higher, with the Dow Jones trading at 29,328. Livestock markets also finished a little higher, with February live cattle up 23 cents at 126.35. April feeder cattle up 8 cents at 147.88. And February hogs up 80 cents at 67.68. Taking a look at our weekly price summary, March corn futures for the week finished 4 cents higher thanks to today's rally at $3.89 per bushel. The weekly range was 15 cents wide from a low of $3.75 to a high of $3.90. March soybean futures for the week were down 17 cents, finishing at $9.29 per bushel. The weekly range was 29 cents wide from a low of $9.20 to a high of $9.49. Kansas City March wheat futures were unchanged on the week, finishing at $4.94, right where they closed last week. The weekly range was 24 cents wide from a low of $4.80 to a high of $5.04. Minneapolis March wheat also finished unchanged for the week at $5.58 per bushel. Grain prices did close higher to sharply higher across the board today. Yesterday, there were concerns that China may not honor its commitments. There was talk that the enforcement mechanisms within the Phase 1 trade agreement didn't have enough teeth in them. Today, there were rumors that 2 to 4 cargoes of U.S. corn were sold to China for shipment off the Pacific Northwest coast. There was also talk that China is still shopping around for additional U.S. corn. Corn was down 10 to 12 cents yesterday on concerns regarding China business. Corn was up 10 to 13 cents today on rumors that China was in actually buying some U.S. corn. Soybean prices and wheat prices were pulled higher by the strength primarily in the corn market today. Despite the extreme choppiness that we've seen specifically in the corn market over the last few days, prices remain stuck within an established range. If we look at a price chart that shows March corn futures over the last just over a year now, over the last 2 months, corn has been in a sideways range between $3.71 and $3.92. If we expand that to the last 5 months, it's still a sideways range with the lows at $3.65 and the highs at $4.71. The bottom line is that corn prices were very choppy late last summer and into the fall. They still remain choppy, just in a much more narrow range. With that in mind, rallies towards the upper end of the recent range likely create selling opportunities, with pullbacks towards the lower end possibly creating buying opportunities for end users. Grain price direction will continue to be influenced by any actual Chinese grain purchases or lack of purchases that we see over the next few weeks, even the next number of months to come. Chinese purchases from the United States could reduce their buying from other world suppliers of grains and grain products down the road. If China buys more U.S. grain, our U.S. prices could benefit, but it could also reduce the export sales by our competition, other exporters, countries like Brazil, Argentina, Ukraine, Russia, and the European Union, as well as other exporting nations. Reduced export sales in these nations going to China could cause them to lower their prices to try and attract additional export business to replace potential lost Chinese business if China buys more from the United States. If that's the case, cheaper prices offered by other nations would encourage other world buyers to purchase grain from our competition and not the United States, and as a result, the U.S. could lose export business to other nations if the U.S. becomes less competitive. With this scenario that we just outlined, it tells us that strength in the U.S. markets due to Chinese rumors or Chinese purchases should be used to take advantage of grain sales. That gives us the ability to be patient on times when the markets pull back. If we take a look at a seasonal chart that shows the last 6 years of monthly ending stocks, so this isn't our final stocks, this is what USDA is projecting on a monthly basis. For example, this year, 2019-2020 crop year shown in red, back in the month of May, the USDA released its first official balance sheet and ending stocks for this current crop year. At that time, the USDA was projecting ending stocks between 2.4, actually close to 2.5 billion bushels, and corn prices were down in the lower $3 range. Large acreage losses and the potential for large yield losses as well caused USDA to reduce its estimate for ending stocks to 1.7 billion bushels in the June report. If you recall, then during the summer, USDA produced bearish news in July, August, and September, with stocks rising back to surplus levels. In October, USDA did lower our ending stocks to just above 1.9 billion bushels, but we've remained fairly close to that level the last 4 months. Our current stocks just below 1.9 billion bushels, definitely below what was expected back in 2016-17 and 17-18, but above the stocks levels that we saw in 15-16 and then again in 18-19 shown in yellow. Export announcements of sales to corn to China would definitely be a positive for the markets, but we're not going to run out of corn, and global supplies are adequate as well. That's why we continue to advise using rallies as selling opportunities. Turning to soybeans, a similar chart, the last 6 years of monthly ending stocks from USDA. In the last half of the 2018-2019 marketing year, USDA was projecting stocks at or just around 1 billion bushels. As we started this crop year back in the month of May and June, USDA was again forecasting stocks close to 1 billion bushels. But due to lost acres and reduced yields, our ending stocks currently being projected at 475 million bushels. This is right in line with what's been projected over the last 4 months. Also keep in mind that with the exception of last year shown in yellow when we had much higher stocks, current U.S. stocks are well within the range of what we've seen over the last few years. Therefore, rallies toward or into the low $10 range certainly providing selling opportunities. Turning to U.S. wheat ending stocks on a monthly basis. USDA began earlier in the year projecting stocks over 1.1 billion. Current stocks at 965 million bushels are the lowest USDA has been projecting so far for this marketing year. But as we pointed out with corn and with soybeans, our current stocks at 965 certainly not tight, well within the range of what we've seen many times in the last few years. And that creates a selling opportunity, at least to get a base of sales on, with wheat prices near the $5 level. Turning now to our daily charts for the corn market, March corn futures down sharply, down 10 to 12 cents yesterday, up 10 to 13 cents today. That leaves us stuck in our pennant formation. That formation is when we see a pattern of lower highs but higher lows. That creates a narrowing formation. Eventually we'll have to break out. It doesn't mean that you'll explode to the upside, doesn't mean you'll crash to the downside. It could mean that over time the corn market remains in more of a sideways range. Nearby corn prices in the upper $3 range, maybe close to $4, would create selling opportunities. Prices down towards the previous lows, at least in the short term, could create buying opportunities. The bottom line is that if farmer producers would sell on rallies, then when the market does pull back, they're not tempted to make sales chasing a market lower. Turning to our March soybean chart, soybean prices pulled back off of the highs that were posted about 3 weeks ago at 961. And the last couple days we've been consolidating now in the middle of a longer term range. Bullish news could return us back into the 945, 950 range. Bearish news maybe back down towards the $9 range. and our attitude on soybeans is similar to that of corn. Rallies back in toward the previous highs would create selling opportunities, and that allows us to be patient if the market would pull back into new lows. Turning to our March Kansas City wheat chart, wheat prices were very disappointing from a chart perspective yesterday, but then today the market turned around and closed with significant highs. The wheat market, like corn, has become very, very choppy recently, with each story regarding exports and China news creating a move in the markets. Bottom line is that we do look at prices near the upper end of the range, around that $5 range, as selling opportunities. That will give us the ability to be patient if the market did push back down into the 450, 460 range down the road. Here are Heartland Farm Partners grain marketing recommendations for Friday afternoon, January 17th. No changes today. We advanced sales a couple weeks ago and we're very comfortable where we're at. 80% sold on last year's corn crop, 75% in beans, and 80% in wheat. We have not completely sold out. If China does come in for big purchases, it may provide an opportunity to make some additional sales at higher levels. About 2 weeks ago, we also advised getting some new crop sales on the books. New crop corn at $4 per bushel, we're advising 40% sold on the insured bushels. 50% on new crop beans when prices are in the $9.70 to $9.75 range, and 50% on new crop Kansas City wheat with prices in the $5 range. We don't have any current recommendations for additional sales on soybeans or wheat. We'll sit tight for the moment there. We do have one additional target to sell 30% of your insured bushels for the 2020 corn crop if December futures can hit 410 or better. Turning to our option recommendations. Following rallies through December and into early January, we did advise getting puts in place against any uninsured bushels for the 2020 corn crop. Puts would be recommended at 100%, 50% in beans, and 100% in wheat. This gives us additional downside protection against those uninsured bushels, which we would not be marketing until we get deeper into the growing season and are confident of those bushels above and beyond your insured level. This is Dan Cowger for Heartland Farm Partners. Thanks for joining us, and have a great weekend.